What's the future look like for the housing market with regards to prices? Where do we see interest rates going and housing affordability? Well, that's exactly what we're going to dive into in today's episode. We're going to do a second half of the year forecast, a little bit of a recap with what we expected to happen at the beginning of the year. We're going to talk about everything from inflation to employment to what the Fed is doing to wages and how that's ultimately going to affect you as a buyer, seller, or investor in the second part of 2024. So, Josh, what did we actually get right and what did we actually get wrong? Let's start there.
Oh, that's an interesting one. Let's start with the biggest one, and it's not for buyers, but for you and I. What we want to consider is how many transactions are available. So if you and I get a certain market share, a certain slice of the pie of available transactions, it is positive to have a growing amount of transactions. Some people strangely think that we benefit from larger transactions where we actually benefit primarily by more transactions. And what we've seen is for the better part of 2 years, housing, not in terms of prices, but in terms of home sales, both new and existing, has been in a recession. So we've talked about the recession. We're going to talk about the possibility, probability of recession today, but housing is in a recession. We are 32, 33, 34% lower in volume of transactions on purchases of existing homes, which is primarily what you represent buyers and sellers on, what I represent buyers to get their financing. So that's what we're looking at and what we're trying to forecast. So let's start with that. You got it just about right. I think your thoughts were that we were not going to bounce off of last year's volume at all. At that time, my belief was we were going to get some relief in interest rates, and even a little relief would take us up to that 4.5 million sales. So 4.1, 4.2, I think is where you were at. 4.5 is where I thought we were going to be. And just put that back into context for you guys. In the middle of the heyday of 2020 and 2021, that annualized pace was well over 6 million sales. Mm-hmm. So it's way, way down. I expected some correction. You expected more of the same. So besides that, what additional thoughts do you have on things we were looking at?
Well, I mean, to follow up on what you said, the headlines read home sales are crashing or home sales are down considerably. Home sales are down 30, 40%, whatever the number is. But the context, right? That's not home prices. That's not, that has nothing to really do with anything that really affects you so much as a buyer other than the fact that there's just less transactions happening in the market. But that's a result of lower inventory out there in the market. It's a result of higher interest rates, lower housing affordability, less people being able to qualify. So very, very important. And while I might have gotten it right so far, Josh, we still have 6 months or so left in the year, right? So I can't say that we nailed anything at this time, but I think, like you said, the biggest hurdle for most people at the moment is affordability. It's not a lack of wanting to buy a home. It's a lack of being able to actually buy a home. And even those rather that are able to buy, with current rates, there's still a lack of available options out there in the market. And we're going to talk a little bit about inventory and where inventory is. But between rates and inventory, Josh, that is the biggest problem, keeping the number of transactions lower. And if I were, right now, betting man looking at the second half of the year, I think the number of transactions is probably going to mimic very close to what we saw the first half of the year. I don't see a big change in either direction, even though we're kind of headed into more of what we would consider a slower time of the year versus the first half of the year.
And remembering that those numbers are seasonally adjusted. So it accounts for the fact that we are coming through the busy part of the year. And just a quick recap. Some of you may be listening going, hey, I listen to you guys every week. You don't need to tell me this for the 9,000th time. But what we see is prices are dictated by the supply and demand balance. So demand is way down because of exactly what Jeb said, reduced affordability. Demand is way down because of reduced affordability. Supply also down because of reduced affordability. Most buyers then become buyers, and they are locked in to really, really low interest rates with very affordable payments. And to cross that barrier for most people is difficult. Jeb, I keep seeing more and more headlines over the last 6-8 weeks of saying, yes, lock-in effect is still real, but it's definitely thawing. And I'm like, who are you talking to? I'm not dealing with very many move-up buyers right now, other than if it's an investor which is not a move up buyer. It's someone buying another property, adding to their portfolio, someone moving across the country. For the most part, it is young, upwardly mobile professionals who have the ability to afford, despite the fact that affordability is at long-term lows. And I think what we're going to talk about today, Jeb, is there's only three things that can impact affordability: interest rates, home prices, and wages. We'll go through that. We'll give you guys an update on it. But the important part is I think affordability is going to improve, but not in such a substantial way that it will necessarily offset some of the other things that are coming. We all want lower interest rates, right? Well, what's going to bring lower interest rates? It's that recession. It is a slower growing economy. It is slower growing wages. So we all sit here. I say we all. Those of us in the industry, those of you wanting to buy your first home, buy your next home, we want affordability to improve. And the easy lever is, hey, I want interest rates to drop. If interest rates are going to drop significantly, it's because there are other negative things happening in the economy. We talk about, for us mortgage people, we're like the vultures. Like we look at, hey, we had a news report coming out tomorrow. Retail sales came out this morning. And normally people would be like, hey, we want the consumer to be healthy and out there buying stuff. And I'm like, I hope they've rolled over and can't buy any more stuff so the rates get better. So it's important to remember that despite the fact you want improved affordability and the easy lever is interest rates are going to improve in a worsening economy. So that doesn't mean that many people won't be insulated from that, but many people will be impacted by that. And we're going to kind of see how that may lead to, despite affordability increasing, some flattening of home price growth going forward.
Yeah, there's consequences to lower interest rates. And sometimes the rates create the consequences, and sometimes the consequences create the lower rates. And at the moment, we're seeing a little bit of change in inflation. We're seeing a little bit of change in employment. And with that, the Fed's stance has changed a little bit. Not necessarily in the way that I think we would have thought back in January, which we're going to talk about that here in just a minute. But before we dive into that, do us a favor. If you find any value in the content that we do here, hit the thumbs up. And if you appreciate the work that Josh and I do, the time and effort, energy that it takes to put these videos on, and you like real estate and want to stay updated, do us a favor and subscribe to the channel. So Josh, let's talk about rate predictions. Let's talk about the Fed, because this is one I think we both got wrong coming into the year with, where inflation was, what the predictions were at the time. At that time, the Fed was leaning towards three predictions. The market at that time, I believe, was predicting somewhere between 6 to 7 interest rate cuts. And as we sit today, the market is predicting 1, the Fed, or maybe 1 to 2. The Fed is basically saying 1. So let's kind of transition into that side of things, because the Fed is going to be one of the key drivers in how affordability moves from here on out.
So remember, again, to recap, 2 mandates for the Fed: price stability, which means keep inflation under control, and full employment. Full employment is a moving target. At one point in my career, it was 5% unemployment. We've been below 3 for the last several years and just ticked up last month to 4%. That's beyond full employment. So the Fed would like to see more unemployment. As crazy as that sounds, they would like to see more Americans out of work. So we're trending in that direction. We're going to go through some data here that says the numbers that they are relying on are horrifically flawed. I don't know if that's intentional or if it's just incompetence, but our government tracks numbers multiple ways. And someone that I follow, that you and I talked about earlier this week, Danielle DiMartino Booth, like at risk of becoming a perma bear where you're just like doom and gloom, everything is falling out of the sky. She did a video, hour-long video that you guys can find on YouTube last week, talking about how the media is gaslighting the United States people on the economy. And she goes through all of the negative things. And you look at it, I see a lot of the things that she's saying because there is good data out there. So part of the reason why I'm going into this detail is, were we wrong on interest rates? Yes. Were we wrong on the economy that should have led to interest rates being significantly lower? I don't think so. When you look at where unemployment is, I think unemployment is significantly higher than what is being reported. And we're seeing that data. So you look, we get ADP every month, right before the government data. We get Challenger job cuts every month. We get Indeed job postings. And you look at all of that, and it's been weakening. And yet every month we get this really strong jobs report. Really strong is relative. It's not like a gangbuster jobs report, but that's hard to have when unemployment's at 3.8, 3.9%. You can only have so good of a jobs report because only so many people are looking for jobs. But when we talk about that, that data is flawed. We're seeing retail sales roll over. We've seen credit card debt go up. We've seen spending go down. So all of that leads to slower growth in the economy. That leads to less inflation as sellers of goods, companies, corporations have less pricing power. We've already seen it in automobiles. These automobile companies got nuts during COVID, and a truck that was $65,000 was quickly $85,000. And now in this economy, people are looking and going, no dice, I'm not doing that.
Well, Josh, let's talk about that for a minute. Let's sidetrack for a moment here.
We're going to talk about Jeb's personal life.
Because Jeb is now, unfortunately, in the market to buy a car and take a car in yesterday. Long story short, going to cost more to fix the suspension on this 2016 GMC with only 85,000 miles. It's about a third of what the car is worth. So that's a logical decision. That's probably not the best car to fix at this point because something else is probably going to go wrong. And nevertheless, I started looking at cars yesterday. Josh, prices supposedly have moderated. It's amazing what cars go for now. An Escalade is now $140,000. A Denali, $102,000, $105,000. I mean, these used to be $75,000, $80,000 cars.
Well, the good news, Jeb, is you can get them for $20,000 off now. The problem is that's still 10% more than where it was.
Yeah, it's insane. Like I'm looking at all dealers, not just like I'm open now. I'm like an open book.
These clowns are not advertising them, but they are letting these things go because they have way too much inventory and they have carrying costs on that. But the way that I know, you guys probably get tired. I always go back to talking to Tundras. So a Tundra prior to the new model year coming out right in the middle towards the end of COVID in 2022, top of the line Tundra was like $65,000. Now a top of the line Tundra is like $82,000, $83,000. And those $82,000, $83,000 Tundras are sitting on the lot. And we're seeing them start to get advertised $15,000, $17,000, $20,000 off. So long way of saying sellers no longer have this pricing power. It is moderated. We talk about if you take a couple of items out, we don't talk about taking housing out. We don't talk about super core because we think that's fair, because most households, their biggest line item in their monthly budget is their housing expense. So if you don't own a house, that is significantly higher than it was, and it's not going down. But it's a flawed metric in the way that it's incorporated into CPI because it lags. So while inflation was getting out of control during COVID, the Fed's looking at it going, hey, we don't have a problem. Everything's fine. And then this lag data comes in and they go, oh my God, we have this horrible case of inflation. And now it's moderated. And you're looking at that shelter inflation still lagging and being really high. If you take that away, many metrics have us at 2%. And every time we talk about this, Jeb, all of the viewers, especially the ones that have just popped their head in and they know everything, say, you're dumb. Inflation is still a giant problem. We are talking about the rate of inflation, not the level of prices. The level of prices suck. If you go and you have to pay $22 for lunch when that was $13 5 years ago, that sucks. Mm-hmm. But what we're saying is next year, it's not going to be $25. You're going to get 2-3% inflation going forward. So from that perspective, Jeb, when we talk about what is the Fed going to do? I think by the end of this year, it's going to be very clear that we are on track to get back to that 2% inflation. We're going to have 4.3, 4.4, 4.5% unemployment. So the Fed is usually, when you look at their dot plots and their predictions of what they're going to do going forward, directionally, they are usually very accurate, but they are early. They're either early or late. Their timing is off, but their direction is accurate. So I don't put any faith into what their dot plots are. We are sitting here making a forecast. And after 2-3 years of doing this, not just personally, which I've always done for my business, but doing it here for the show, I'm starting to realize the futility of it. We have to do it as professionals because I have to know how much staff do I need? What do I think this year is going to look like? How can my household spend money if we know what's going on? So we've always done it, Jeb, but you and I showing up here, it's been a humbling experience. So that's not just me. I mean, those guys are PhDs and lawyers and whatnot on the Fed, but it is just that hard for them. And they have some pretty significant biases that I believe are leading them astray. So your question was, what does that mean for interest rates? I think they're going to come down faster than the Fed thinks, but slower than most all of us thought. And it will be a slow grind down.
Well, let's talk about rates. Let's save rates till the end where we actually talk a little bit about numbers. And I don't think you're giving us enough credit here, Josh, because we have been right. Interest rates have moderated a bit. Inflation has moderated. Employment has moderated in a way that we see the economy slowing. It's a little more obvious now, I think, to the person that doesn't follow this as closely as we follow it, than it was 6 months ago. But now the signs are starting to show up. The headlines are starting to change a little bit. And it looks like the narrative a little bit, the stance from the Fed, while it's hawkish, it's not like this overly hawkish stance. It's still a wait and see. We're here, we're data dependent, all of the things that they've been saying, but nothing leading you to believe that, that a rate cut is completely off the table. And, the latest prediction I saw is somewhere between September and December, potentially 2 this year, depending on whose forecast you're looking at. So,
and Jeb, just on that subject, 2 would be absolutely on the board right now if it weren't for the election. You have a 60-day period that I believe we have 2 meetings that everyone is saying the Fed doesn't want to appear political just before or just after the election. And they say they don't care. They're going to do what's right for the economy. And I say bullshit. They will stay out of the way. They do not want to appear partisan to either side. And depending on what you do and when and who wins, either side could say you were being partisan. I don't think they want any part of that. So I didn't mean to cut you off.
Here's the thing is, like, I don't necessarily disagree with that, because I do think there's some truth to it, but I also don't like the conspiracy theory of like, hey, this is like the data's manipulated, that they won't do it because of X or Y, right? So, but I do agree with what you're saying, but I think just for purposes of the show here, let's disagree. Let's say I think one's going to come as early as September. I think it could happen prior to election in November. Because I think the data is going to continue to soften, but
I don't disagree. And if the data softens, and I could absolutely see a path to that. So it's going to need to be so clear that it's easily justifiable. And talk about conspiracy theorist. The Fed is not perfect. The Fed is flawed in many ways, but I don't believe they are partisan at this point in time. Both of the candidates running for president want to induce partisanship into that. But for the time being, I don't believe they're partisan. I believe those people are going to get together and do what they think is best for the U.S. economy. So I'm not the one that's going to point the fingers. It just opens up Pandora's box. If you cut just before and something shifts gears and the election goes a different way, 50% of the people in the United States are going to point at them and say, you guys are partisan. You guys did do this on purpose. I would want no part of that if I'm a Fed member. It's like, we'll do this in December. We'll do the one cut. And if we have to get more aggressive next year, we will.
Yeah, and time will tell. We've talked about that. Let's talk about, before we talk about rates, let's talk about the metrics of affordability. Home prices being one of them, wages being another, and rates obviously being the third component of that. Wages, we've seen moderate a little bit since the highs that we saw during the pandemic.
A lot, Jeb.
I don't remember what we said where wages were going to be, but we're still trending 3-4% on wage growth, which is normal for the most part, right?
Well, normal, if you go back, we had a 20-year period of 2% inflation, plus or minus, some periods below, some periods above. And we had wage inflation just above that, about 2.3, 2.4. So that's a good thing. We have real wage improvements for people. Well, starting in COVID, that shot up to like 6%. And now we're down under 4 as of the most recent reading, but that's still 1.5% above where we were. So inflation is below that. So we're kind of at real wage gains. If we're talking about the employment market not being as strong as people think, unemployment going up, we've already seen a downtrend in wage increases. I think inflation comes down. Real wage increases stay similar, but actual wage growth is going to moderate back to what we've seen historically, where you're about 0.2, 0.3, 0.4% above the rate of inflation.
Yeah, which ultimately, if you're a home buyer out there, is going to have little to no impact really at the end of the day on you being able to improve affordability to some degree.
In the short run. In the short run, you're 100% correct. In the course of a year, if I say, hey, Jeb, you're going to make 3.5% next year, you're not going to go, oh, cool, now I can afford more home, or now I'm comfortable giving up renting and becoming a homeowner. But if you look forward 5 years, 3.5% compounded over 5 years is not 17.5%. It's like 20, 21% wage growth. So if you and your wife both make 50 grand right now, $100,000, and you're like, we can only afford a $300,000 house, we're going to make 120 grand in 5 years. And if rates drop during that time, like we believe they're going to, that house is also going to get cheaper. So those things moderate, but no one is 100% clear on that. We could see a situation where inflation stays at 3% and wage growth drops to 2%, and you're going, in real terms, I lost. But what we're also saying here, Jeb, is there's CPI inflation and then there's home price appreciation. So if CPI inflation moderates, but home price inflation stays at 5, 6, 7%, and you're getting a 3% annual increase, you're falling further behind. So that will go into the forecast of where we're going to update. We've talked about, we think rates are going to be better. We think unemployment's going to be higher. We think wages will be up in both nominal and real terms. But where does home price appreciation go as part of that?
Well, I think that's kind of the next leg of the stool to talk about here, right? So currently, year over year, depending on who you look at, Case-Shiller, Freddie Mac, somewhere around 6.5%. Annual appreciation, and that's moderated a little bit month over month, but it's by 0.1 point. It's minimal. Forecast going forward, I think home price appreciation is going to continue to moderate. I think you're getting signs that there's more inventory in a lot of markets out there. Even here locally, we've got more inventory on the market than we had last year. Is it something to be concerned? Is it something to be super scared about? No. I mean, we're not even close to where we were prior to the pandemic. But more homes are coming on the market. Whereas last year we had more or less peaked at this point. We didn't see a lot of homes on the market until later in the year. Now we did. I think we had a late peak last year, like November is when inventory peaked. But this time of the year, we weren't really adding any new listings to the market. This year's a little bit different. And so I think you're going to continue to get a little bit more inventory just because, not because there's that many more homes coming to the market, but just because there's less people out there purchasing the homes that are on the market. Therefore, they sit a little bit longer. Days on the market go up. They just get added into that pool, so to speak. So I think as the year goes on, home price appreciation is going to moderate. Is it going to be 1%, 2%? I know there's some predictions that we're going to talk about here in just a minute. I think you're probably, somewhere between 4% at the end of the day. It's hard to say because a lot of it depends on rates. If rates drop in a significant way down into the 5s, which is what I predicted at the beginning of the year, and we'll talk about that, which I still don't think is off the table. You could see a surge in buyer demand, but is it so late in the year that those transactions don't fall into the following year? That's to be determined.
Hey, a point on that inventory that I would like to make, because everyone, and us included, points to the chart and says, yes, we are up 30% in most markets in terms of year over year inventory, but we're 30% shy of 2019 and holding out 2019 as a normal market. Well, that was a normal market with 4% interest rates, affordability at much better levels because lower home prices, lower wages, but lower home prices, significantly lower interest rates. So I'm telling you, if we talk about supply and demand and able demand, people willing and able to qualify for a mortgage and buying a home being the important thing, if we got back to 2019 levels of inventory, we will see home price decreases because we have less able demand out there. Not people wanting and willing to buy a home, but people able to qualify and sign on the dotted line. So I don't think that's coming, but that is what we're talking about, moderating home price appreciation going forward.
Well, it's important to note, right? So every week on our live on YouTube on Wednesdays at 5 p.m. Pacific Standard Time, if you're listening to this in the first time, we answer buyer questions. We update you on the economy, all of that. Every week we look at inventory, and there are some markets right now in the United States, Josh, that are up not only year over year, but back to those 2019 levels. The first market that comes to mind that it kind of stands out every single week is Jacksonville, Florida. They're back to 2019 levels. Now, does that mean prices are crashing? Not necessarily, but it does mean that it's more of a buyer's market there than it is say here in Southern California where we are, right? It's something to pay attention to. So, this is that time in the show when we talk about real estate being local. Don't just listen to the forecast here and say Jeb and Josh are talking about prices continuing to go up 3-4% for the year, whatever. Understand markets change or markets vary. And so just make sure you understand your local market, what's happening there with inventory, demand, all of that, because that is a larger piece of what you should pay attention to than, say, a national forecast, which is essentially what we're doing here.
Broad forecasts are irrelevant. The example I always like to use is prior to 2008, the national news media loved to say home prices have never decreased year over year on a nationwide basis. Awesome. I'm not buying a nationwide index of homes. I'm buying a home in a local market. And many local markets had and did continue to have corrections and crashes from that time. So you absolutely have to know your market. So with that in mind, Jeb, I know that we just discounted national forecasts. Let's talk about a couple of national forecasts. This time of year, we have a few of the economic groups coming out with their updated stuff, but most don't really update mid-year. They'll come back at the end of the year and do next year's forecast and say, here's what we thought last year and how it came out. But a couple of good ones here. Both of these are going to include a Moody's forecast for May 24. So basically where we just finished to May of 2025, the next 12 months. Zillow is now predicting a 1.2% year over year loss. Now, the important thing, I'd love to bash Zillow here, but it's not really a bash Zillow. It's a thing to remember about their forecast. It is truly a nowcast. It's the information that they have available now. And if rates drop significantly, they'll adjust that and say home prices are going to go up 2.5%. But right now, with all the data they take into their model, they say down 1.2%. Moody's says the latest forecast up 0.4%. So that's less than kind of where we've been. I don't know if that's less than what you thought. You were saying, hey, where do we end the year? We've already seen if we're 6.5% year over year, most of that is front loaded in the first half of the year. So we've seen most of it. We've probably already seen 4% this year. So if you get another 1% the rest of the year, you're at around 5%. But going forward next year, what are your feelings on a nationwide forecast of being slightly down or just barely positive?
Into 2025, a year from now?
A year from today.
Wow, we're getting even further out in our second half of the year forecast.
Yeah,
we're going into 2025. I will say a lot has to depend on rates. Kind of keeping the same thing. I think the market that we're in 2023 and now in 2024, I don't want to say this is the new norm because I don't want to believe that it's the new norm, but I do believe a slower moving real estate economy, if you want to call it that, is what we're going to experience because again, even if rates come down to 5.5%, you still have a lot of people locked in with lower rates that are just going to choose not to move for one reason or another. Affordability is still going to be an issue. Inventory is still likely to be a problem. So there's just not going to be enough transactions in my eyes to get the traction you need to see major appreciation nationwide. So I don't think you're going to be down necessarily. But I think something in the small, single digits, 1 to 3 is probably realistic.
Let me piggyback off that. I've said here many times that the most healthy thing for the U.S. housing market would be for the next 5 years to have 0 to 2% appreciation. Mm-hmm. So if we see that, I would be thrilled. I'm gun shy here. When I look at that, I don't look at that and panic and go, oh my God, that would be terrible. I go, that means a nicely balanced market where home prices stay stable for a little while so we can see a normalization over a period of time versus looking back at the last 3 or 4 years of just the greatest appreciation in a 4-year period that anyone's ever seen. You get 3 or 4 years of 1% appreciation. You'd look back at the last 7 to 8 years and go, oh, it's almost normal. It still would be a little high, but almost normal. So let's take a look. Goldman Sachs and again Moody's do forecasts out to 2027. So you and I are not going to do a forecast out to 2027, but it's interesting when these groups do look that far out. They are forecasting many, many things in the economy that we just can't foresee. But for 2024, Goldman says plus 3.8, Moody's says plus 1.5. I think we've already blown through that for both of them. So unless you see depreciation in home prices the rest of the year, it's not going to work out. Goldman sees 4.4 for next year, Jeb, and Moody's the 0.3 for 2025.
And I think it's important to note Zillow, Moody's, Freddie Mac, Fannie Mae, CoreLot, like these guys have been right some years. They've been horrifically wrong some years. So, don't take any of this and run with it. It is literally a couple of economists, maybe, I don't know. I say a couple, could be 10, could be 100 within a company that come out with these forecasts, but it is no different. Take it as any other forecast, and it's just that. It is a forecast. It's not in stone. So
especially when we're comparing two groups like this. I do like the wisdom of crowds approach. If we get to the beginning of the year and in January, I've got 14 forecasts and you start to see a consensus, there's 2 or 3 outliers on the high end, 2 or 3 outliers of pessimism, and most people are aligning somewhere in the middle. Doesn't guarantee they're right, but I do like that more than this. So Goldman's 4.9 for 2026, Moody's 0.9%, Goldman 4.9 for 2027, Moody's 1.7. So they all see appreciation. They both see appreciation over each of the next 4 years. They vary pretty greatly. I hope that Goldman is wrong. If we go 3.8, 4.4, 4.9, 4.9, we're not seeing improvement in affordability. Rates are not going to drop enough to absorb, 25% higher home prices from where we are. It's just a hard thought to swallow, and I don't see enough demand to push home prices that much higher over the next 5 years.
All right, so rates are kind of on the calendar here, or the next thing to talk about. Before we do that, though, let's talk a little bit about recession. Recession predictability. Do we see a recession in the second half of 2024, Josh?
People I respect think we're already in a recession. And when you look at the way they calculate them and when they say it actually started, they only see them in the rearview mirror. I don't doubt that sometime here in the middle of this year that we are in a recession. I'm not saying that we are, but if you told me with everything we're seeing, that seems reasonable. You just can't have everything that we've gone through and not see a recession. So I do believe we will have one. I think it's going to be mild. If you look back to the great financial crisis, the great recession, so to speak, what we saw is double-digit unemployment. And the Fed jumped in with QE, pushed rates really low. So you had low inflation, low interest rates. Despite that, people weren't buying assets, even though the financing of it was really, really cheap. So I don't see anything like that. If we get a recession, it should be a mild recession, at least mild in scope to the last recession, because none of us really considered the 45 days at the beginning of COVID a recession.
Good stuff. So now where everybody is anxiously awaiting our forecast, Josh, rates, interest rates, mortgage rates, Fed funds rates, whatever you want to talk about here, the 10-year, where do you see us ending up a couple months from now, 6 months from now? What are your thoughts?
Let's go out to November, the election. And I'm not going to tell you folks who winning would do what to interest rates, because it may shock, surprise, or sadden you who would do what. Neither one of them are good for the long-term economy. They both want to spend a bunch of money that we don't have because they're politicians. But let's say prior to that, because that can be your wild card. Once someone is now the president-elect and they have a plan and an agenda that they say they're going to pursue, that could have a negative or a positive impact on where interest rates go. But I think based off of the trajectory of the economy, we bottomed, fourth quarter or first of January here at about 3.8, 3.83, something like that.
On the 10-year, guys, not on the 30-year.
Not on 30-year mortgages, but on the 10-year. I think it's reasonable that we get to there before the end of the year. I think it's reasonable that you see the spread to 10-year treasury to mortgages getting to the low twos. So it's 2.1, 2.2, 2.3. It would put you into the low sixes. And government loans are already there. Quoted a couple folks 6.25 on government loans today. Very reasonable for that to happen. So we've talked many, many times that your standard balance, Fannie Mae, vanilla, well-qualified borrowers about 0.5% higher than that. So some people are well under 7% right now. But I mean, really, it would take a more rapid deceleration of the economy and the Fed jumping in with 2 or more cuts to see rates going much below the low sixes. So that would be my projection there, somewhere between 6 and 6.25 by the fourth quarter.
I'm going to keep my prediction essentially the same. I think you could see a 5 handle on a 30-year fixed rate. Not for everybody, very well qualified. Now I'm not talking 5.1%. I'm talking 5.8, 5.9%, somewhere in that ballpark. I think that's reasonable. Just because I do think employment, the numbers are continuing to soften. Inflation, we've got some big months coming up here with regards to month over month numbers that we should be, we were 0 last month. And, there's a high likelihood 0.1 or so gets inflation under 3%, I believe, on a headline number. core, not far off from that. So with that, I think that gives the Fed enough to say we're seeing inflation moderate, even though they're probably not going to say that. But I think spreads normalizing a little bit is going to help rates. And rates are going to trend lower. So that's my prediction. I don't know that, Josh, if I'm looking back at the beginning of the year and looking now, I don't know that anything has really changed. I think my forecast is still feel really the same. It's just a kind of a blah market is how I refer to it. I feel like it's not fast. It's not fancy. It's not fun, if you will. It's hard work. You're doing a lot more putting time, effort, and energy into making less money is really what it is from the real estate and mortgage side. And quite frankly, I don't see that changing.
Well, if anyone's followed me around for the last 10 to 14 days, they know that it is not. It's not in any way a fun market right now. So many of us are questioning our life choices. And before those of you at home who love to throw stones at other people say, well, that's your payback for the great, awesome 2020 and 2021. Well, remember, we were all on lockdown and mortgage people got to work about 30 hours in a 24-hour day and got to have everyone yell at them because everyone was overburdened and working remotely overnight. So it was great income-wise, but it also was not a fun time. So I'm not asking for any sympathy. I'm just saying that it is an interesting and difficult and crazy market, partly because of that cyclical ebb and flow of the market is we are chronically overstaffed, understaffed, letting people go, hiring, and it's just a difficult time as the mortgage industry and real estate to a lesser degree adjust to what the new normal is and how to service the buyers that are wanting to get into the market. So with that, I am still a strong believer that home ownership is the right decision for the vast majority of people over the long term. You have to have a longer term time horizon, 5 to 7 years. It has to make sense. I had a gentleman call me this morning, listener to the podcast. He's probably listening. He's under contract to buy a home in Texas, Jeb. And he calls and says, hey, I have a co-borrower. I've been approved for the loan, but my income is X and my payment is this. And it was like a 52% debt to income ratio, just the house. So he couldn't qualify for it without the co-borrower. I said, well, is the co-borrower living with you? Are they going to be helping make that payment? No, they are not. I said, okay, is there any additional income besides qualifying income that makes you feel comfortable to have this? He goes, not right now. My wife is outside of the U.S. working on getting her work authorization, and she will come here. And 6 to 8 months, I'll have additional income. So, okay, 6 to 8 months. I said, you have a cushion. After you close, will you have some additional funds to cover that 6 to 8 months till your wife gets here and add some income, preferably a little longer? He goes, no, I do not. I'm going to use every last nickel to close on this. I said, that sounds like a recipe for disaster. He happened to be in Texas. I said, look at the charts in Texas. We're not seeing massive appreciation, if any appreciation. So there's no urgency for you to jump into the market now. Wait till your wife gets here. Wait till she has a job. Wait till you guys save another $5,000 because you now have two incomes. Now you're going to close without the co-borrower, with a lower debt to income ratio, with some reserves, with some comfort in your mind that you can make that payment. So long way of saying the answer over the long haul for most people is absolutely buy the house. The answer for everyone today is not buy a house. So make sure you're talking to people that are going to work with you to go through those numbers to make the best and right decision for you and your family.
And with that, guys, inventory is going to come to the market. There's going to be opportunities out there, but you have to be ready. And with that, I mean, you need to start doing the pre-approval process now. You need to start processing the paperwork now. Talk to Josh, talk to a lender, a mortgage professional, and run the numbers to see where you stand. That way, if and when it does happen, you're in the best position possible to take advantage of it, and you're not behind the 8 ball scrambling like clients of mine to at the last minute to say, well, we weren't sure, and now we found the right one, and we need to make an offer, and it's like go, 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 when it could have all just been thought out and planned a little bit more in advance. And so with that, if you need to get in touch with Josh, you're looking for a second opinion, you're already in process, go to the referral link in the description of the video. You can connect with Josh. And if you're looking to buy a house, you're here in Orange County, I personally would love the opportunity to help you. You can get to me through that same referral link. And if I can't help you, I'm happy to refer you to somebody that does business just like I do. But either way, we appreciate your time. We appreciate the support, and would love to know what you guys think about the forecast. Let us know in the comments below. But until next time, buy right, borrow smart, build wealth. Adios.
Amigos.